Hello, everybody, and welcome to this week's edition of Selfwealth Live, the technical analysis edition, the final edition for this year. I hope everyone is going well on the other side of the line. Hello, Jason. How are you today?
Hey Rog, I'm good. Looking forward to doing our last show, talking about the markets, looking at the stocks, and plenty going on. So hopefully a good show into the end of the year.
There's always something going on in this holiday period, Christmas period. It's not just the markets, obviously. It's all the stuff how you manage the markets, buying things in the physical world as well, not just on the stock market, right? So a lot to manage in this period. So I'm looking forward to this show, and also I'm looking forward to. Hopefully, some entertainment throughout our technical analysis in all the stocks that we're going to analyze for this show. So, for everyone who doesn't know, obviously, we've been doing this for about 2.5 years, or close to 2.5 years actually. And the way we do this is we analyze the Australian market, the US market, and the Hong Kong market. And then if there's any general questions, we'll try and answer them as well. And then it's all about your tickers. So make sure you put in at least one ticker, and we'll try and get to as many as possible within the hour or so time frame we go for. But I'm excited to get this going, Jace. Let's have a look at that disclaimer before we go.
Yeah, so just a quick note about that. So everything we do today is general commentary only. So no personal advice, and this disclaimer just goes through all that. It also goes through that I'm not part of Selfwealth Safe. My business is Motion Trader. You'll see my details at the top, licensing, etc., are in there. And beneath there, the Selfwealth disclaimer, again, licensing, general commentary, all those important things are on that slide.
Okay, fantastic. So, as I said, get your tickers in. We try and aim for about one per person, but it all depends on how many put their stocks in. All right, so let's get cracking with the Aussie market, Jace. It seems to be just sitting there, not doing much. Are we expecting this Christmas rush or Christmas
Yeah,
buy?
let's get into this ASX 200. And there are a couple of important developments to discuss today, Rog. So, firstly, we've got this break above resistance that comes in around 8,600. See that blue horizontal? There's a high. That's a previous all-time high from February over on the left, and then you got some more technical activity through the year. And here we are. It's so far it's just a nudge above the resistance zone, but it fits with that buying pattern we've been discussing over the last couple of weeks, and that buying pattern started with the strong rally off the November low, and followed by a shallow consolidation. And shallow consolidations are always a sign that there's buying interest in the dip. And it's that buying which keeps the consolidation shallow. Now we've got this little push to the upside. And I think this now sets up a key test of that buying interest. So just look at where prices are now. So they're directly below the moving averages, and the moving averages have rolled over and have just started to cross to the downside. And now, if the rally is going to get sold, this is a classic place for selling to emerge. I can show you a quick couple of examples. So here's an example from March where we had like an initial sell-off. We had a fairly shallow rebound towards the moving averages. Then the selling came back in, pushed prices lower. And if we just scan back, there's probably another one to look at. Here's one from 2023, where the market fell, rallied back to the moving averages, and then the selling came in and pushed prices down to a new low. So that's not to say that's going to happen here, but that's what we now want to look out for, because we're at that point, we're at that classic sell point where if selling's going to emerge, well, this is where it would often come from. If I was just to look at this chart in isolation, if you just put this chart in front of me, didn't tell me what it was, I'd be a bit concerned. And my key concern would be that there are declining moving averages and that prices have been consolidating beneath the moving averages. So that always opens a window of vulnerability. And well, that's what I think anyway. At least nearly always opens a window of vulnerability, and it's something we should be aware of. But I think there's more to this than just a single chart, and it's always the way when you're looking at markets. It's often more than one thing. You've got to put all the pieces together. I'll show you what I mean. So let's go to the ASX 200 on an equal weight basis, and so this provides, I think, a very different picture to what we just saw in the ASX 200. So while the ASX 200 is below declining moving averages, the equal weight has been consolidating above moving averages, which are still generally rising, especially the 100-day moving averages. Still rising. So I also like that the pullback we've had a pullback to around the 100-day moving average, and there's been a strong rally off the low, and that's a sign of buying intent when you get those strong rallies off the low. And then look at the consolidation. It looks like it looks shallow. It looks shallow and corrective, and it's just sitting around the 50-day moving average. So this is a chart of a market that seems to be preparing to push higher. The most important point here is the equal weight, I think, is a better gauge to what's happening in the broader market than the ASX 200. And that's because it's not dominated by a few big banks or a couple of big miners. All the 200 stocks are equally weighted. So you get that broad-based idea of how things are struggling or how things are going. And so then you wonder, like, you ask, well, why does the ASX 200 look like maybe it's struggling below those moving averages? And I think it all comes down to weakness in the big banks. So we'll just quickly jump to the financials index. And so this is what really has been weighing down the ASX 200, and it's not helped by the fact that CBA, which is the largest stock on the ASX, it's currently down around 20% from its June high. So this has been this big weight on the market. So I think it's why when you look at the ASX 200, we're getting a different picture than the equal weight. So I think the financials are distorting what's generally playing out across other parts of the market. I think the good news with financials is that they've now stabilised, and we're now seeing a rally back towards the moving averages again with the financials. I think the key will be to see prices back above the moving averages. I think that's the key for the financials and the key to getting that weight off the ASX 200. Overall, just quickly back on the ASX 200, overall, this is a market I want to remain long. I'm continuing to treat this move from the October high. I'm continuing to treat this as a pullback within an uptrend. And I think the odds favour a rally above these moving averages, not a breakdown to new lows. But I really want to see the market above those moving averages just to diffuse that window of vulnerability, which we typically get below the moving averages.
Okay, fantastic. So what you're saying, just to confirm in my mind, is that with the financials are the main, obviously being the biggest in terms of companies on the ASX 200. We're not just reliant on those big banks. We've got all the other end of that ASX 200 that's looking much better than what the regular ASX 200 is looking like. Is that right?
Well, that's right. Just take that mental snapshot of the ASX 200. Now look at the financials, and there's a pretty strong correlation there. Kind of like, and that's because CBA is the biggest, and then the other four big banks, they chip in, and that's a mighty weight in the ASX 200. Now look at the equal weight when you take those four big banks, they're now just 4/200ths of the calculation, and you get a very different picture. So I think that overall market is doing better than what you'd presume if you just looked at the ASX 200 in isolation.
Okay, well, this is great information to hear, because most people, once again, they wouldn't really look at these equal weight indexes. They would just look at these things and think it's not looking the best. But when you have some perspective of other charts and other indexes, and know that the ASX 200 is not just comprised of the big banks and probably some larger miners, then there's a lot more companies there that are holding up the fort, which is great to hear.
And that's why I say it's often more than just one thing. It's like you're putting together a few pieces, like a big puzzle. You've got to bring all the pieces together to get the true picture. If you just look at one piece, well, you're you might, well, you're probably not going to get the full picture. These things are never sure things by any stretch, but that equal weight, I think it looks a lot more encouraging than just looking at the ASX 200 on its own.
Fantastic. All right. Nothing's a sure thing, but let's have a look at that US market. If that's okay.
So over to the S&P 500. Now, this has been a fascinating week in the US market. On the surface, you might look at this and think, well, the S&P 500, it's it hasn't particularly done too much over the last few days, and that's largely true. Prices have mostly been trading sideways this week and the week prior. And that follows a strong rally off the 100-day moving average. So the blue line is 100, the red line is the 50-day moving average. The consolidation follows a strong rally off the 100-day moving average about 3 weeks ago. As we discussed last week, the strong rally coupled with this sideways trading above the moving averages, that's typically a bullish thing, as it indicates that there's interest in buying the dip. And of course, that's continued this week. We've got this sideways movement. But it's what's happening below the surface that I think is fascinating. And this is something that most people have probably missed, because most people, as we just discussed with the ASX 200, they look at the big headline index, not things like equal weights. So let's jump to the S&P 500 equal weight and see what's happening over there. And I'll show you what I mean. So the equal weight has broken out to a new all-time high. And in doing so, it's leading the S&P 500 index, which remains just below its October all-time high. So just quickly back to the S&P 500, see, it hasn't made a new all-time high. There it is back in October. Come to the equal weight, and we have a new all-time high. So the broader market is outperforming the big tech stocks. And this isn't a rally built on, it's not a rally built on AI or AI stocks. It's stocks with exposure to the broader economy, which are really doing the rallying at this point, and which to me, I think that's generally bullish for the market overall. This week's rally also saw a breakout from a 2-month trading range. Actually, might be close to a 3-month range now. So I just put it on the chart, and you can see this range. The equal weight's been in since going back to late August thereabouts. So about 3 months or so in a trading range. We've now got this this breakout. And what's also interesting with this is that the equal weight had a false break to the downside in late November. You can see this breakdown here. We talked about this at the time we got a breakdown, and then it quickly failed, and the market started to rally again. And you might remember, we spoke about this last week, and viewers might remember what we said about that last week. We discussed how a false break is a classic sign that buyers remain the dominant force, because you don't get that follow-through selling. And when there's fear in the air, as there has been in the last few weeks, when there's fear in the air and a break to the downside fails, it tells us that the path of least resistance is most likely up. And of course, that's what we've been seeing this week with the break to the top side in the equal weight. I thought the breakout may have taken another couple of weeks. I thought maybe we could have just tracked sideways, a bit like the S&P 500. But that's trying to fine-tune timing, and that's always a tricky thing. I think the most important thing here is that we have a process to identify the path of least resistance and then be positioned accordingly. The big shift we've seen in the last 2 weeks is a significant improvement in the breadth of the market. So that's like the participation. There's more stocks participating, and I think high participation is a key indicator of a healthy market. I think the key point here is that this remains an uptrend. All-time highs is, you can't get more of an uptrend than all-time highs, and I think we should still be positioned accordingly. Of course, always managing our risk, because things can change, but at this point, nothing's changed to alter the rising trend.
Yeah, all right, fantastic. And the one thing I noted amongst the major indices in America was the Dow Jones. We start of the week now. Last week, at the end of the week, was all-time highs as well. Do you take that into account at all? Or?
Yeah. I look at the Dow, and we could tell a similar, another story about that here, like all-time highs in the Dow. It's not an AI dominated or a tech orientated index. But look, yeah. The equal weight tells the story for us as well. But you get that confirmation in the Dow. The lagger at the moment is the Nasdaq. The Nasdaq is the furthest from its all-time high. So maybe there's some sort of a rotation going on out of tech and into other areas of the market, because we are seeing other stocks rising. You can't get the equal weight hitting all-time highs unless you've got a lot of stocks pushing upwards.
Yeah, a good perspective, and we're not just looking and just boasting about AI like a lot of the media outlets are doing, or the gurus are doing, right? So it's great perspective that we're being able to see here, Jay. So thanks for that. Let's have a look at the Hong Kong market then.
Yes, over to the Hang Seng, and prices continue to consolidate within a range below the October high. You can see since October really just tracked sideways. I've been watching this tight trading band just over the last 3 weeks. I think the inability to rebound off this November, this 21 November low, the inability to get a strong rebound off that low, and instead prices have just really just trading along the bottom. I think that is a bit of a concern. If prices were to break below these recent lows, so breaking below the November and October lows, well, that could trigger a larger pullback. I'm still working on the basis that this overall upward trend remains in place, but yeah, there is some near-term vulnerability to monitor. Really like to see this have a strong move up towards the upper end of the range to diffuse that vulnerability. So yeah, just being aware of these low points. Like, I don't think a breakdown below there opens up like a lengthy bearish period or anything necessarily, but I think it would lead to a longer consolidation. So something to watch there. And then over in the Chinese market, stocks have had a better rebound off their 100-day moving average. It's still not an amazing rebound, but it's a better one than we've seen in Hong Kong. I think if Hong Kong were to break down, then China would probably then come back. The Chinese market would probably come back and retest this late November low, and again, then that could lead to a longer consolidation. It's kind of in a holding pattern at the moment. We don't have a near-term trend in place. It's just we've got both of those indices moving sideways. I think the underlying trend remains up, but it just could be more consolidation over the coming weeks until maybe we get some upward resolution. Maybe that's into the new year. At the moment, though, it's that underlying trend is still good, but it's just how much longer or how much lower could the consolidation play out for.
All right, fantastic. Pretty straightforward there for those markets. Okay, well, let's get into having a look at some of your stocks now. Merry Christmas, Bob, to you. Hi, Martin. Let's have a look at 4DX, please. A renewed buy here, breaking out.
Yeah, big rally off the moving averages. And, we so often see rallies start from these moving averages. If I was in this stock, I'd continue holding it. I'd find it a harder one to sort of get in at this point, just because, like, where do you put your stop loss? It's like to buy it currently, it's like you're 40 odd percent back down to the 50-day moving average. So yeah, I find it a tougher one to buy, but certainly one I'd want to be staying in. It's this has been a huge run, hasn't it? Like, and there was like a buyable entry signal too. Moving averages crossed, shallow consolidation back to the averages, and then a strong rally. So it's a sort of, it's got that structure which is gettable, and which has led to big gains, and then wide trailing stops staying on board. And I think that's still the play now. It's I'd want to be staying long with a wide stop back below the 100-day moving average.
Fantastic. Hi, Jennifer. Thanks for your support over the years. Let's have a look at ASL, please. Motion Trader Silver Stock.
Yeah, so this is in a clear upward trend. It's rallying off the moving averages. It seems to be like breaking out of this sideways consolidation, which has had along the averages. It's a stock with like I'm holding a different motion trader silver stock, just doing the same sort of price action. I'm happy to hold that, see where this whole thing in silver goes. It's like silver is historically at like extreme levels above its 50-week moving average. It's not the sort of sector which I'd be keen in doing a whole lot of new buying, but it's like, but I'm happy to stay on board and manage risk around what I have and see where it goes. I always say, let the trend surprise you on the upside. So I want to stay on board, but I'd be careful chasing silver stocks. If I didn't have any silver stocks, I'd just be being careful with it. By all means, follow breakouts, but I'd want to be keeping my risk fairly small because silver is historically very stretched at the moment.
Okay, fantastic. Look, the person underneath Jennifer, you're always here as well. So thanks for your support over how long you've been with us. I just don't know your name because I can't pronounce your handle because it's in another, obviously, language. But thanks for there and thanks for your tips. Let's get on to Robert. Hi, Robert. Okay, Wayme. MVF, please. And then waking with me is hand pink waving, all these different emojis. Work that don't know, but I'm waving back at you.
Was that MVF?
MVF.
Monash? Oh, well, this is price action's improved. I remember somebody's asking about this down at the lows in mid-November, and I said, "Look, this is a stock I'd just be staying away from." And it's like, well, the moving averages don't predict the future. They just tell you what's currently happening. They tell you the current structure, and then it looks like not soon after I said, "Look, I'd be steering clear." It's gapped higher. I think maybe there's some takeover talk in some private equity maybe looking at. I'm not sure. Something's in my mind about that. So yeah, look, these things can happen. It doesn't have quite. It's certainly improved its situation. It's back above the moving averages. The moving averages turning higher. The step for me to now want to buy and to possibly get a motion trader signal is now once the moving averages cross, it's breaking to a new high. So it'll be above the new high above where we were in late November. So if I wasn't in this, I probably wouldn't buy just yet. Like if there's takeover speculation around it, well, that's the reason it's jumped. So that probably usually doesn't lead to a large ongoing trend. It's really like leading into a potential deal. So upside could be limited anyway, unless you get a bidding war, and that becomes that's another thing. But we don't see so many bidding wars nowadays. Look, if I was holding it and I've got that gap higher, by all means I'd be holding on to it, but probably not one I'd be looking to buy just yet.
Okay, fantastic. I think we've looked at 4DX already. Let's have a look at Google over in America from Bryce. Hi, Bryce.
So Alphabet is Alphabet is Google's holding company, and this trend remains up. It's moving averages are pushing higher, having this pullback towards the averages at the moment. Nothing unusual there. Saw something maybe similar back around September. Prices got a bit away from themselves, had a zigzag looking corrective shallow pullback to near the moving averages and rallied again. It's like if I'm holding it, I'll continue holding it. Like I've got S&P 500 exposure, so by default I've got exposure to Google. yeah, look, I'd just be holding it. I probably wouldn't be buying it just now because it is consolidating. It's still above the moving averages. We don't know how long that could play on for. It could rally again in the near term, or it could continue to track sideways. For me, it's probably one I'd rather just hold if I had it, rather than buying at this point. See how the price action develops. Maybe there's another opportunity in the days or weeks ahead. But at the moment, yeah, very much a hold.
Yeah, I think we probably a good idea just to, because obviously Google, the behemoth it is, it's kind of like it's good. It's probably good just to recap the fact that we are looking at this from a midterm technical analysis perspective. If you've got some other fundamental reasons why you want to get into such a big company, obviously you've got to do your own due diligence and see if this is a good price for you to get in, right, Jose?
And look, it's also up over 100% since the April lows. So it's doesn't mean it can't go up another 100%. But often when you get these big moves, you also get a proportional consolidation. It takes time. So happy to hold. But yeah, as you say, everyone will make their own call about their reasonings for getting in. From my perspective, I'd be happy just to wait for now.
Fantastic. All right, let's go have a look at CNB, please. CN for Nelly and B.
Yeah, it's its structure's improving. I actually had this stock a little while back. I bought it as prices are breaking higher, and then I think I sold it. My time exit went off, and I sold it when it was down below the moving averages. And soon after I sold it, it started to push higher again. And these things are going to happen. And at the time, I was happy to get out because it was starting to spend some time below moving averages, which were turning. But it's since got itself back above the averages. Looks like there's some rising lows since early November. You can see these series of rising lows. It's making some new highs as well. It's if I was still holding it, I'd be happy to continue holding it. It's like probably look, as long as it stays above its recent lows, it's got that near term momentum to it. Would I buy it at current levels? Look, I guess if I particularly liked it, maybe it could be bought at current levels with a stop. It could be done maybe on like 15% or so, just below the most recent low. So if it breaks that recent low, well then it just severs that upward momentum, which it seems to be building, and then maybe it just takes longer. Or it goes back into a range and just chops about. But if it can continue building, like it's had a rally so far, it's been a modest pullback. Maybe some buy here with a stop below the low, or watch and see if it holds those gains and then breaks to a new high. That could be an entry point. So there's a couple of different ways that could be played. There's certainly potential with it. I didn't like how it quickly gave back those gains during late October, early November, but signs since then have been encouraging. It's not the cleanest of structures, but it is one which certainly could support higher prices. I think there's like an asymmetric opportunity in terms of like we can keep risk relatively tight, and upside is open. So yeah, it'll be an interesting one to keep an eye on.
All right, let's have a look at the DRO, probably our stock of the year, I think, in terms of movement, that's for sure.
Yeah, and now it's rebounding again. It's I'd be steering clear of it at the moment. It's all just a bit of a mess. It's like it's not unusual that we're getting a rebound back towards the averages. So when a stock goes from above the averages quickly to below, it's like it's like when you stand on a chair and drop a ball. It falls, it hits the ground, and then it bounces back up. And stocks tend to bounce back up towards their moving averages. Saw something similar after the fall in July last year. Fall from great heights, hit the bottom, bounced back towards the moving averages, got a bit above, but then the bounce lost its spring and came back down again. So what happens here, I don't know. It could bounce higher. and then it could stall and come back down. That would probably be, I think, for me, I think that'd probably be the most likely scenario, that we're just getting a bounce and it runs out of steam, then it comes back. And it's a sort of stock that now needs to do quite a bit of work, because it's a PR issue when the directors are selling all their shares up at the top and then stock comes down. Like, is it going to head back to those highs anytime soon? And I suspect not. Of course, I could be wrong, but it's probably a stock I'd rather just watch out of interest rather than try and buy it. If I'd held on from this long decline, I'd probably be looking at this rebound and going, well, this could be my opportunity just to get out of a position which may not be doing anything interesting for a while now.
All right, thank you. Thanks, Mohammed. Hi, Shamita. Let's have a look at MTH.
Yeah, going on the name, silver and gold, so I don't know whether they've got resources or reserves or whether it's just exploration, but to be in a hot sector and have the shares trading down below their September low, it's not a great thing. We've had a rebound off the lows back towards the moving averages. It looks like a strong rally, and so far we've had a shallow pullback. That's an encouraging sign, but it's not the sort of stock I'd be interested in looking at the moment. It's like I think people sometimes people like to look for stocks which in a hot sector which have been left behind, and often stocks are left behind for a reason. There's just there's something which means hasn't been keeping up, so they don't play catch up. It may prove to be the case here. Maybe they find something or something happens with the company and does good things, but at the moment we're not really seeing any great strength or structure in the share price. It was looking encouraging, like at this point through July, August into September, consolidating on the moving averages. Looked like it had been setting up for a breakout, and with silver and gold doing what it's done, you would have expected it to have broken out, but instead it broke down. So that's like just a flag for me. So I don't want to get involved, even though it's a nice rally off the low. I don't like this sell-off section during a bullish period for the sector. So I'd probably just leave this one alone. That said, if it rallies up again, gets above the averages, holds those gains, starts to break higher, well, then we've got breakouts and we say, well, look, okay, well, the structure's supportive, maybe we go with it. But I think it needs to do a bit before I'd be inclined to give it a go.
All right, fantastic. Thank you. Merry Christmas to you as well, Laurie. I see you got a few in there, Mohammed. If we've got time, we'll circle back, but we're just trying to get to one from every person at this point. Hi, Lyndon. Thank you. And hi, Lang. Let's have a look at theirs, which is SNS, please. SNS. G'day, Sydney. We'll get to yours as well, since we've already done 40X.
SMX, it's not.
Sorry, SNN.
Right. Okay.
S as well.
SNX.
SN and S again.
SNS.
Yeah.
Eventually get there. Okay, third go. Hopefully I got it right.
That's the one.
Low price stock. It's had a run. It's come back to the averages. Yeah, as I often say, low price stocks that jump, a lot of them don't continue on into big, long lasting trends. At this point, like, it's not a stock I'd be buying at this stage. If I was holding it, and if I was in at lower levels, or even if I was in at lower levels, sure, I could continue holding it. Maybe I'd give it down to around 5.5 before saying, look, it just keeps coming back, and I just want to protect what capital I've got. if I'd bought it, say we got that initial rally, then we got a consolidation towards the average, then we got a breakout. Say we'd been buying around 9 cents. We've got a little bit of a run now. It's pulling back. Again, I could give it a bit of room, maybe to about again 6.5%, 5.5% max, maybe, before saying, look, I want to have a set exit point. I want to think about my exit now, so I'm not just wondering every day, will I keep holding? Will I sell it? Just like, look, this is my line in the sand, and I'd be sticking with it. You never know. These stocks could run. This sort of stock can certainly run again, but it does have history of disappointing, of having runs and then coming back. So it's like, is this run different from previous runs? It's like, well, it could be, but just be prepared that it has form on the board for disappointment. So that's why I'd suggest having that fixed exit point. And if it surprises us on the upside, great. If it doesn't, we protect our capital on the way down.
All right, fantastic. The next one is G'day, Max. Good to see you joining us live finally after no more babysitting. Let's have a look at SVR, please.
SVR, I've got this stock myself. Had it for a bit early this year. Can't quite remember when. Maybe it was around April sometime as things were breaking up. But look, I don't remember when. It's a motion trader stock. Been in the motion trader portfolio for a while. It's taking its time, but its structure is good. This is like, it's been a long consolidation since May, but all the dips continue to get bought, and prices are above those moving averages. They're pulling back again towards the averages. If they can, it's a sort of stock which we could see. I wouldn't be surprised to see price action as such, like maybe a touch more sideways, then a breakout, and then then an ongoing trend. That would be price action like I've seen many times before. So I'm long, happy to stay long. Give it room to move about. Maybe it needs more time to consolidate. But if I'm in at lower levels, wherever that may be, if I'm in profit and it's trading sideways, that's okay. It can just sit there and do that for as long as necessary. Maybe it's also paying dividends as well. I'm not sure whether this one's paying dividends or not. But sometimes you get paid to sit there and let it go sideways. If I was thinking of buying it, I'd probably want to buy a breakout at this stage. We can say there's some resistance just overhead at those highs. So if we get some just consolidation beneath that resistance, then a break higher, maybe it's a buy around like $1.85, $1.86 or something. That would probably be the play for maybe even adding to a position or buying it for the first time. That's probably how I do that. But for now, for me, it's a hold, motion trader, calculated trailing stop, and that's how I'd be playing it.
All right, fantastic. Hi, Lloyd. Bit of a question around TWR. It's on the New Zealand Stock Exchange as well as the ASX. How do they work together? Are they correlated?
It'll be you get dual listed stocks. Does this have NZX? There it is. So it looks like just from the share price, it looks like the NZX is the main listing. Like, see the local one's patchier, the share price action's patchier, and then we go over to NZ on the NSX. Where's it gone? There it is. And you see you got it's not as patchy. So it's the New Zealand market, that must be the home exchange. There's a local listing for whatever reason, and it'll it's going to do the same thing. There's going to be adjustments for the currency and such, but it's the same stock. It's got the same trend, and if you can trade it in New Zealand, it's probably the better exchange to trade it on because it's more liquid, because it's fairly illiquid on the Aussie market. But it's a lovely uptrend. It's been trending higher for well over coming up to almost 2 years of trending higher. It's been a good trend, and it remains in place. It's been slow and steady, but in that nearly 2 year period, there's been some very good gains.
All right, fantastic. Hi Astro, Merry Christmas to you as well. Let's have a look at AIS, please.
And I got some of this as well. And just when I say I've got something, it doesn't mean it's a special stock or it's going to do extra well, because I get plenty of stocks that don't work out. I spoke about one of them a little bit earlier, AUR, I think it was. But when they work, it's like we let profits run and see where they go. I got some of this as it was breaking higher around September, somewhere around like just below 30 cents. I think I got in. It's a motion trader stock. Motion trader signaled it a touch earlier. We had this nice moving sideways, trading sideways along moving averages, which had crossed and started to turn higher. Then got a breakout from there. So that's one of the nicest asymmetric entry points. Asymmetric, where you can just risk a little bit, just a stop back below the moving averages, or back within the range, and open upside. And we got great upside with it. Now it looks like it's still part of a consolidation. Like it's had a big run from 20 cents up towards 60%. So it's got a couple of 100% gain depending on where we measure from. All sorts of ways this could develop. But, one of them is there could be there could be more consolidation. It could pull back further and then move within a range for a bit, and then from there start to break higher. So there could be more consolidation before further upside. That would be pretty typical sort of price action that we often see. It could rally from here. Of course, it could fail altogether. Got a stop loss if that were to happen. I'm happy holding, giving it time, giving it room. Probably not in a hurry to buy it at this point if I'm not already in it, because we are in a trading range. We've got a high, we've got a low, and they're our boundaries at the moment. We're trading in between, so it could continue to oscillate between those two points. So I'd be watching it if I wasn't in it, but happy to hold it as I'm in.
All right, fantastic. Hi MJ Gal. Let's have a look at WC8, please.
Yeah, it continues to build. We've got this series of rising lows, rising highs, moving averages keep turning higher. I'd be wanting to hold on if I had this one. I could probably even, could it be considered now? It probably could be considered as a buy now, with probably needs like a 25% trailing stop back to just above the 100-day moving average, below these low points from late November. I'd probably be inclined to be happy just watching it for maybe another few days, another week, see if we get some sideways, a bit of sideways consolidation. And if we see it holding onto these recent gains, we've got that nice recent rally. If we see it holding onto those gains over the next few days, maybe that's a buy the dip as the moving averages catch up, or buy a breakout to a new high. But yeah, certainly one I'd be wanting to hang on to, see where it goes.
Fantastic. G'day, Danny. Good to know your name. Finally. All right. Let's. Thanks for your support. Let's have a look at Sydney's. Hi, Sydney. Thank you for your support. EOS, please.
Yeah, it's been a volatile sort of stock. Like a 60% pullback. It was hard to have seen that off. I think this has been a motion trader stock in the past, but even a wide trailing stop for me isn't going to be able to see off a 60% pullback. But now we've got a rally. Is a new trend starting? So we've gone from below the averages to above. Averages are starting to turn higher. If I was holding it, I'd keep holding it and see how this develops. could be a case now that we've had that initial rally from below to above. Maybe there's going to be some consolidation where it just consolidates that rally we've just seen over the last week. And what I'd want to see a shallow consolidation. I want to see it holding onto its gains, and that could set up a new entry point. So I'd be looking at this from the perspective of a where can I get in? But I'm just not sure of the timing. I think we need to see the price action develop. Like if say we were to buy it at current levels, where do we put our stop? Do we put it below the recent lows? But that's like 50% away almost. It's too much. I can't manage that risk. Or below the moving averages, it's still like a bit over 30%. So I'd be inclined to watch it. I want to see a consolidation, like whether it's something like such, and the moving averages start to turn. We just got to wait and see. But one to look for an entry opportunity, or one to hang on to if already in.
All right, fantastic. There's a few general questions in there. We might wait till the end for them, so I'm not ignoring them. But hi, Mick, let's have a look at SVL.
Yeah, making its way upwards. It hasn't been as strong as some of the other silver stocks, like ASL and USL, I think. But nonetheless, it's positive price action. It's like pulled back to the moving averages, held the averages, rallied off them again. Looks like it's in a bit of a range at the moment. But I like the latest rally off the 100-day average. It's come back to the 50-day average, is now holding there. So it could be a case of, what could we do? It could potentially be bought at current levels with like it's going to say, look, it could be bought at current levels with, say, a 20% stop. The problem with that is, what if this turns out to be like a larger ongoing range, and we do get a move back down towards the bottom of the range and some chop, and then from there it starts the rally. So that's the risk with buying at current levels, that it's still a range, which is bigger range, which is forming. We have a high point, a low point. There's going to be back down here, retest towards it. May not even get that far, but could still be like more downside within a range. That's I think that's a tricky part with buying it now. We just to buy it now, you're kind of punting that the range is done. It's pulled back and it's ready to go again. In which case, maybe it's better to just buy it at 23 cents on a breakout. Happy holding it if I had it. I'd probably wait. Probably not buy it just yet. I'm also concerned that silver looks so stretched and could pull back. It could keep charging. We don't know, but we just always got to be mindful of risk when things are really, really stretched from their averages. So I'd probably just wait before buying this one. But if I had it, as I say, happy holding it.
All right, fantastic. Hi, H. Break. Let's have a look at BPH, please.
Was that? What was that, Rog?
B, and then P for Peter, and then H.
This the right one? BPH Energy?
I believe it's that one, yeah.
Yeah, not much going on here. Yeah, look, I not one I can do much with. It's just sort of like it's mostly just bouncing along the bottom at 1 cent. Had a blip up and gave it all straight back. It's one of those stocks where it's like people are attracted to these. So I think, well, 1 cent to 10 cents, and I'm up up nearly 1,000%, but 1 cent to 0.7 cents, and you're down 30% pretty quickly. So I'd just leave it alone. I can't even see a strategy where we can really manage risk. No, you can. It could be bought at current levels. You have a stop at 0.6 cents, but you're risking 35%, and you're hoping that something's going to kick in. We don't have a trend at the moment. And the last time it tried to break out, it came straight back. So it's not a stock I'd be able to use a strategy with any confidence, unfortunately.
All right, thank you. Hi, Lisa. Let's have a look at your first one, please. RCE.
Yeah, it's running. It had that nice structure where sideways along the moving averages and then the breakout. That's all textbook. So this would probably class as this would class as an emerging trend. It's like, can it sustain its momentum? Can this trend develop into something larger? If I'd bought earlier in the last few months, I'd certainly be holding it. If I'd bought this recent breakout, I'd certainly be holding it. If I was looking at getting in now, I'd probably just wait a little bit, just see whether maybe there's a bit of a consolidation starting to form while the moving averages catch up. Could just get just that little bit more sideways price action, and that could be a buy the dip if we get another pullback down to around 55 or so, or maybe a breakout above the recent high should more of a consolidation develop. But one I think to hang on to, or wide trailing stop back below the 100-day moving average, or motion trader calculator stop even better. And if looking for an entry point, let's just see how this what looks to be a consolidation. Let's see how it develops. Yeah. But plenty of upside potential. Like, it's a stock which has been down and out for a while. I've seen many stocks like this, continue on to large trends which run a long way. So whether this will be one, time will tell, but it's certainly got that upside potential to it.
Fantastic. Hi, Yu-King. Let's have a look at PDN.
I must have
D for Derek. PD.
Right. Paladin. So I've got some Paladin. Bought some last week after selling it. So I was talking in my Friday strategy session about how I'd bought it as it looked to be breaking up sometime in October. Then I sold it at the lows in November when it looked to be breaking down. So that's what we call whipsaw. So whipsaw happens when you buy near the highs and the trend doesn't develop, and you sell near the lows and then it rebounds. But then since I've sold, the trend has come back and we're back above the averages. So I bought back in last week. So hopefully not getting whipsawed again, but you never know. It can continue to happen. This is a thing when you're buying within ranges, when you don't have that clear-cut trend. It's just like we're working with a potential developing trend with this. And if it can hold the moving averages where it currently is, it's like this, again, this typical pattern sideways along the moving averages. We could see this continue to develop to the upside. It's definitely got that potential. Whether it happens or not, it's yet to be seen. The uranium price it's also in a range, but it's a range which looks like it has sensitivity to the upside, but we don't have the breakouts yet. So, uranium's still a developing situation, not one which is currently unfolding to the upside. I'm happy to continue holding my position. It could be considered. Someone could consider buying it here. I think buy at current levels, stop below the recent lows, 16%. That's probably reasonable. Or wait and see if we get sideways consolidation and buy a breakout, maybe above Friday's high. We get sideways and a break above Friday's high. I could consider adding to position there. So it's certainly one to keep an eye on and consider an entry plan or holding if already in there, but also being aware, like, where's my exit point should it not work out.
Mm-hmm. All right, fantastic. Hi, Stevie. Let's have a look at BKB, please.
Look, it's a bit messy. There's not clear cut structure. It had been trending. Had been progressing nicely with these rallies and pullbacks. Even then, it was like some of these pullbacks were a little bit deeper than I would would have liked to have seen. And then it shot away and then quickly gave it all back. So I find this one a bit of a messier chart. If I was if I was holding it, I don't see too much harm in continuing to hold with an exit plan, maybe back towards from current levels. Maybe it all depends where I've got in as well and stuff. But look, if it finds its way back below the moving averages, I'd back towards 58 cents or so. I'd probably be thinking, look, is this a stock I want to stay in? I might be considering an exit strategy at that point. But if I'm in it, I could probably hold on for the moment, but it's not one I'd want to buy just yet. The structure needs to clear itself up a little bit. For starters, establishing above the moving averages would be a good start. So just trading sideways, holding onto the recent gains and breaking higher again. That's the price action we need to see. Otherwise, it could just be a case we're just oscillating either side of the moving averages, or it's a rebound and then it continues to trade lower. It's not a clear cut one. This one I'm happy probably not to do too much with.
All right, fantastic. I think we might leave it at that for the tickers, because there's a few there's a few obviously with second options here, but we're probably going to run a bit shorter time, and we want to really start keeping this to about hour shows now. So we've gone through the first of everyone's ticker at this point. There's a couple of general questions which will go around the tickers anyway. So first of all, as you mentioned about takeovers before, Jason, I just want to know your thoughts around this, and it's good for viewers to know as well. So general question: when a takeover offer is made and the stock jumps up, do you wait till the takeover settles, which is obviously could be months off or whatnot, or sell after the price jumps?
I think every situation can have its differences. Sometimes I've held to completion. Like if there's say the indicative takeover price is $1 and the shares jump to 80 cents or 90 cents, but they're still 20 or 15 or 10% below the takeover price. Well, I might just continue to hold and let that gap close. If the shares are trading, maybe they're trading at 99 cents, but the takeover has it's got another 3 months to go because it's going through the court, and but the directors have recommended and everything. Maybe I'd sell it at that point and say, well, look, I don't want to hang around 3 months for 1 cent. I might sell it now. Of course, there's always a possibility someone might come in with a competing bid and push the price higher. So that's a risk of getting out early. So and that may be situational as well. The takeover company may already have a large stake, which means it's hard for someone else to come and take it over. So it'll vary from situation to situation, depending on the situation. Again, what's the consideration the takeover company is providing? Is it all script, or is it all cash? Like if it's all script, I'm getting shares in another company, well, I'd probably sell it close to the end of trading for the company being taken over, because I may not want shares in the new company because I've probably been holding the target company due to it being in an upward trend, and I'm playing it that way. I'm not taking a fundamental position on the company or the industry, so I may not want the new company, so I'd probably sell. If it's all cash, sometimes it's easy just to let the deal go through and have the cash appear in the account. I might pick up an extra couple of cents, and it mightn't take too long to wait. It might just be a couple of months, and so it's going to vary. I don't think there's a set rule. This is what you should do. I think you should look at every situation with an open mind and just calculate. Okay, what if I sell now? What if I hold on? What's the risk reward? And make a decision accordingly. So I'd like to say this is what you do, but that's kind of what you do. You just got to assess each situation on its merits.
Of course. All right. I think there's a couple of questions in there which I kind of like. We could probably mix them together. But, we commented earlier on the show around the financials being the sort of the thing that's weighing the overall index down slightly at the moment. I guess does this all of a sudden mean that a company like Commonwealth Bank is a good buy? Let's just have a look at that technically at this point.
No, it's not one I'd be racing into at the moment, because at the moment we have a shallow bounce below declining moving averages. It's like it's a vulnerable it's a vulnerable structure, and it does open the risk that you get a break to the downside and further losses. So that's a concern with CBA. And if that happens with CBA being such a big chunk of the market, like it remains a weight on the ASX 200, then we're looking at the equal weight, going, well, what's the broader market doing um, when we put CBA's weighting into like 1 out of 200 stocks, as opposed to like um, is it 10% of the market or something? It's a large weighting in its current form. So it's not a structure I'd want to buy. To consider CBA, I need to see the price back above the moving averages and then re-establish above the moving averages and look at it then. Um, I, I'm just looking for at like past price action, see whether there's any good lessons that we can learn. Well, look, just during this period, during 2018, like, there's a rally back to moving averages, below declining moving averages. I don't want to buy, because this is a vulnerability which persists. Consolidation into declining moving averages, then another sell-off. Now, at some point, it does tend to bottom and push back higher, but even then, it can still be, there'll be more chop, and maybe CBA's great run is over for the time being. This has been a spectacular run since we had the COVID lows, and we had like a lengthy, we had multi-year consolidation. Uh, as I often say, big upward moves often lead to lengthy consolidations. We've seen that before. We've had a big upward move. Maybe we're going into a phase where CBA goes into a lengthy consolidation. Probably not a stock I'd be targeting. Well, it's not a stock I'd be targeting at this point below the averages. Uh, yeah, yeah. One I think to leave alone, and it is such a big influence on the ASX 200.
Yeah, and I think this just leads to, once again, just because we speak a lot of what we speak to is buying into strength in a company, right? If we look at companies that are breaking down and getting weaker, for us, it's not an indication to buy, right? So that's the point that we've been making a lot over the last few years, right? Trying to buy companies that are showing strength, and this leads me to this other question here around the Oz Tech. Which I've never heard of. This, if we type in AUST space tech, I'm assuming it's this one that Mick AUST, and then TECH. It's like it looks like some sort of thing on the Nasdaq. Maybe put a space in between it. When I was looking it up, put a space in between Oz and Tech. It should come up. That's it. There you go. That one there. Let's just have a look at that one, because the question here is this the Oztec is still being sold off for no real reason? If you click on that, apart from just being unloved, your thoughts as some good companies appear cheap.
So is it around the structure of this? So what the Nasdaq Australian Technology Index? Well, the structure on this isn't what I want to look for, because, like we were discussing in CBA, it's below these declining moving averages. That's not to say it's not going to bottom and be a great buy, but we just don't know how long a market can stay below declining moving averages. There's nothing to say it can't come down, retest the April lows. That said, it may be at the lows now and rebound, but it's my process is really about buying into strength. It's not about trying to predict the lows. Like, someone could say, look, it doesn't matter where you buy, this always goes up in the long term. And it's like, well, yeah, that has been the case, but it's if you're going to have a process, like your process can't. I don't think your process can just be, look, I just buy things when they're just in declines because one day they're going to go up because some at some point maybe they don't. It's not where I want to buy. It's not to say it can't base here and turn higher, but I'd rather buy it on the up move than buy it on the slide, trying to preempt a turnaround.
Yeah, yeah, and I think once again this sort of confirms a lot of the times when I hear, it's fine. If you've got a fundamental reason, because it's a great company. There's a lot of great companies out there with a not so good share price. Based on some of the great fundamentals these companies have as well, right? So if you've got a fundamental reason to purchase, then that's your choice, and definitely it's up to you, right? But when we're looking at these charts from a technical basis, sometimes for us it's just for Jason's method and the one that I've been following in my portfolio as well. It's always looking for companies or ETFs or whatever index you're using that are going into strength versus trying to pick lows. I've certainly tried to pick lows in the past randomly without a system, and it's never ultimately worked for me. So I don't know if it has for you, Jason. I'll probably answer that, but yeah.
I've tried all sorts of things in the past, and yeah, just trying to pick lows and falling stocks hasn't generally worked out too well for me. Like this is the ASX All Technology Index, so it seems to be fairly correlated to what we just looked at a moment ago. It's like looking at where we are now. Is that the low, or are we more like at this point here, like using this example from 22? Is it more like we're here and there's still more to come? We don't know. So the path of least resistance at this point is to the downside. So do I want to jump in front of something which is moving in the wrong direction? And yeah, my answer is no. That's not to say that no one should do it. If someone's got a long-term dollar cost averaging strategy in technology and they buy every month, well, that's what they do. That could be part of the strategy where you're buying into something which is in decline, because that's what you do every month. You buy, and then over time you tend to do very well if you're in the right sort of growth industries which continue to do well over time. But from the approach I use, it's not what I do. I don't dollar cost average, and I'm not buying into a falling market.
Yeah, and I think I think there's probably some amazing companies in that all technology index, right? That make up that index, but obviously the price overall is not showing too well at the moment from a technical perspective. So, and I know once again, like if I compare portfolios, my hit and hope portfolio, these were ones that I thought they were great companies, and they never went anywhere. If anything, they lost a lot of money. Versus the companies that I pick now, I have no idea about, but they come up on a service, it's your signal service, Jason, or however you want to filter stocks, trying to buy them into strength using your technical moving averages, whatever you use, right? These are companies I've never heard of, and yet they're outperforming anything I'd ever bought in the past of companies that I knew or heard about, right? So it's all about your system. And I think that's the most important thing to take into 2026. If you don't have that system, or if you don't have that written trading plan, if you don't have the rules around how you purchase companies and more importantly, how you get out of companies, how you exit, then I think I urge everyone, because it's something that I've become such someone that advocates for it so much, that to have a plan and have a business plan and have a trading plan and have that exit and entry strategy, because without it, I probably wouldn't still be in this game, Jace, right? So and I see so many people that don't. I see so many people that don't do it. I hear so many people that don't, not just see us. I hear about it, right? So I'm sure you do as well, don't you, Jace? So.
Yeah, look, very much.
Yeah. All right. Let's. I think we should probably finish up here. I think, as always, we thank everyone for their attendance today. We thank everyone for their attendance over this year in 2026. I wish everyone a happy holiday season, a Merry Christmas and a Happy New Year that's coming up, obviously, and stay safe, obviously. Don't forget, in 2026, we will be back around the 20th of January. So we're going to have a bit of a break, about a 4 week, is it 4 weeks, 4 to 5 weeks break? We'll be back around the 20th of January. If you are not a Selfwealth client or a Jason client, then you can obviously subscribe to the Selfwealth YouTube channel, absolutely free. You get notifications when we're back, when we're coming back, obviously. If you are a client of either, you're going to get an email and whatnot when we come back, right? If you aren't a client of either, then obviously you can check out the Selfwealth deal down below, and there's 10 free trades to check us out, and maybe getting yourself into a new broker for 2026. And if you need a system and a trading plan and all those things that I've spoken about, then that's what Jason is there for, obviously. And you can see his link below as well. So don't forget to comment down the bottom, like and subscribe as usual. Thanks again for your help, Jason, this year. It's been great.
Hey, Rog, that's been fantastic. And thanks to our viewers for joining us each week. It's like, the viewers make the show. No viewers, it's like we don't do this. So thank you for joining us each week. So many great stocks and interesting stocks to have a look at. It's been fun, Rog. Look forward to next year. And I'll continue doing strategy sessions over the next few weeks. So if someone needs their market updates, well, I'll continue to be putting stuff out.
All right. So if you're not over at Jace's World already, then go and check out his website and sign up there. Okay, everybody. Well, we will catch you in 2026. Have a great time, and we'll see you later. Take care. Bye-bye.